In this business of speculation, the smallest things often betray the largest truths. And that brings me straight into today's idea, the 1 pip rule, the micro move exposed. Before we get into the meat of it, let me say this naturally ties right back to something I mentioned in the previous video on profit from the first trade, because the same habits that guide your earliest entries also guide the way you read these tiny price shifts that most folks overlook. Now, traders talk all day about big swings and major reversals, but have you ever stopped to ask yourself who really notices the tiniest movement on the tape? Most people glance at the chart and wait for fireworks. I learned early that the market whispers before it shouts. A 1 pip flicker, a little needle, tip shift. Those are the tells. Those are the fingerprints of intention. And if you've been around the pits long enough, you start to see those micro moves as the first shadows cast by the larger swing that may or may not materialize. But tell me, have you ever stepped back and asked what a 1 pip twitch really means? People think price only matters when it runs. But the truth is, price matters all the time. The tape is always talking. When the market hesitates for just a breath, that hesitation is data. When it nudges 1 pip against the common bias, that nudge is information, and information is the trader's lifeline. You can't build anything, wealth, skill, confidence, unless you respect the weight of the smallest signals. Most traders want to bully the market with their own ideas. They want big confirmations. They want the chart to validate their hopes. But hope never made a dime in Wall Street, and it won't make one in the forex market either. Tell me, why ask the market to reassure you when it's already showing you its hand? The 1 pip rule isn't about overreacting to noise. It's about understanding the difference between noise and intent. The beginner thinks those micro moves are random jitters. But randomness doesn't repeat itself with consistency. Randomness doesn't show pattern. Randomness doesn't pressure levels or tease breakouts. But watch a chart long enough. Truly watch it, and you'll see when that 1 pip tick is just a tremor and when it's the first footstep of a crowd. Have you ever noticed how price sometimes tests a level so gently, almost respectfully, before it decides what to do with it? The professionals learn to respect that test. They know that the market rarely leaps without first tapping the floorboard. That tap, that slight press, that single pip, it's the reconnaissance mission before the advance. You don't need a crystal ball to trade. You need respect for the clues. And when you learn to read those small tells, you stop fighting the market and start moving with it. You stop chasing and start positioning. And positioning is where real trading lives. Your money mindset shifts too. Instead of thinking, I need a big move to make this worthwhile, you begin thinking, I need a valid signal to make this decision worthwhile. That's a wealth builder's mindset. Not chasing profits, but chasing good decisions. And good decisions come from good information. The micro moves feed you that information if you're patient enough to interpret them. Let me ask you, are you watching the chart, or are you just waiting for it to scream? Some traders can stare at a screen for 5 hours and not see a thing. They're waiting for confirmation so big it slaps them in the face. But big confirmations come after the opportunity has already leaked away. That's why you need to learn to pick up on the whisper. The 1 pip rule is the art of noticing the whisper before the chorus. And don't misunderstand my meaning. I'm not telling you that every little pip is a prophecy. That's the kind of overconfidence that empties pockets. I'm saying that the serious trader treats every movement as a clue in a broader investigation. Because trading is investigation, you study behavior, you observe reactions, you weigh probabilities, you manage yourself more than you manage the market. And speaking of self, have you ever asked yourself why you ignore the details? Some of the greatest trades you ever make will be born from moments that felt insignificant at the time. A slight break of structure, a tiny rejection, a 1 pip flick above a level that tells you the pressure is shifting. Those aren't accidents. They are habits. Habits of price, habits of liquidity, habits of crowd behavior. People behave in patterns, and markets are simply people acting in numbers. Respect the smallest footprints, and you start noticing where the herd is stepping next. And right here, in the middle of all this, let me remind you how this ties back to that earlier principle we discussed in the profit from the first trade video. Your very first trade works best when it's built on observation rather than expectation. These micro moves are the same kind of observations. They help you avoid forcing a trade and instead allow the market to come to you. It's the same discipline, just applied at a smaller scale. Price shifts like a current, subtle at first. If you ignore the shallow tug, you'll never understand why the river pulls hard later. The one pip rule teaches you to feel that tug. It teaches you to see intent forming before the inexperienced crowd sees opportunity. And that's where the edge lies. Not in prediction, not in fancy strategies, in understanding intent, in seeing the early signs without rushing to act on every flicker like a nervous gambler. Tell me, are you studying intent or just praying for movement? Listen long enough to the market and it begins to feel like a living thing. It breathes. It hesitates. It pokes. It tests. It retreats. It advances. And always, it signals before it commits. That first pip is often the signal. Not a full signal, not a final decision, but the hint that tells you where to look next. And wealth in this game doesn't come from jumping at every hint. It comes from studying them, stacking them, and acting only when the story they tell is clear enough to be worth your capital. Capital is oxygen for the trader. You protect it not by being timid, but by being selective. And selectiveness starts with interpretation. You don't need to predict the future. You need to interpret the present correctly. Just one pip can be the market's way of nudging you, saying, pay attention. And the trader who pays attention is always miles ahead of the one who waits for certainty. When I say the one pip reaction exposes whether the market respects a level, I mean something far more subtle than beginners ever imagine. Most traders think respect is shown when price hits a level and bounces cleanly off it, or breaks through with some dramatic candle that everyone can point to. But markets aren't usually that polite. They rarely give you those obvious signals right at the moment you need them. More often, the first sign of respect is just a tiny shift, maybe one pip, maybe even less than the eye catches on the first pass. And that micro reaction tells you something about the character of the move that's unfolding. Have you ever watched a level so closely that you could feel the hesitation before the chart even printed it? A level isn't important because you drew it. It's important because the market acknowledges it. And acknowledgement happens long before the big reaction, long before the clean bounce, long before the breakout candle that newbies wait for. That first small push, 1 pip, 2 pips, just a needle's width, is the market's way of revealing whether participants are paying attention. If price walks into a level and doesn't react at all, not even a flicker, that tells you the level doesn't mean much to the crowd. It's just a line. But if price touches that area and shows even a slight hesitation, that hesitation is intent, and intent is the most valuable clue a trader can get. Let me ask you, are you tracing lines on a chart, or are you watching how the market behaves around them? When you start to pay attention to this micro behavior, you realize levels aren't rigid walls, they're pressure zones. The market feels its way into them. It taps them, nudges them, tests them, pulls away, approaches again. That's how the crowd negotiates price. And that one pip reaction is like the first handshake between the buyer and the seller at that zone. It's subtle, but it's real. Most traders miss it because they're zoomed out too far mentally and emotionally. They want the dramatic signal because they're uncomfortable making decisions based on small, real-time information. But trading isn't about dramatic signals. It's about reading behavior. It's about understanding the nuance in how price arrives, not just where it goes. Have you ever noticed how 2 touches at the same price can behave completely differently? The 1 pip hesitation might look insignificant, but it's actually the earliest sign of order flow negotiating the area. When price respects a level, there's tension, like the market stepping lightly to see who will move first. That tiny reaction shows there's interest. Someone is responding. It might not tell you the direction yet, but it tells you the zone matters. And in trading, the difference between a meaningful area and a meaningless one is worth its weight in gold. You don't want to trade every level. You want to trade the levels that provoke a response. A trader who ignores the one pip reaction thinks, that's nothing. A trader who survives long enough learns that nothing is actually the beginning of something. The beginning of a bounce, the beginning of a breakout, the beginning of absorption, the beginning of exhaustion. Whatever story is forming, it usually starts with a micro move. And the earlier you recognize that story, the more selective you become with your entries. Selective traders protect their capital, and protected capital gives you staying power. Staying power is how traders grow, not from forcing trades, but from understanding behavior. You can think of it like watching someone open a heavy door. They don't charge through immediately. First, they press their hand lightly against the handle. They test the weight. They see if it pushes back. Only then do they commit. Price does the same thing with levels. The first pip is the test. If the market respects the level, the test is visible. If it doesn't respect the level, the test barely exists. It's a simple, natural reaction, but it reveals everything about the sensitivity of the area. And once you understand that sensitivity, you understand how the next move is likely to unfold. Tell me, are you studying the touch, or just waiting for the door to swing open? When you watch the tape with this kind of attention, the one pip reaction becomes a language. It tells you when buyers are defending a zone even lightly. It tells you when sellers are probing but not committing. It tells you when liquidity is thin or when orders are stacked. A hard rejection tells you aggression. A soft one, pip pause, tells you caution. And caution from either side is valuable information, because cautious participants become decisive participants as soon as the pressure builds. And the one pip reaction is the earliest symptom of that pressure. The idea isn't to trade every micro move. That's gambling. The idea is to recognize when the micro moves reveal something bigger brewing behind the scenes. A level the market respects is a level you can work with. A level it ignores is a level you avoid. That's discipline, not avoiding trades out of fear, but avoiding them out of understanding. Discipline built on observation becomes confidence. Confidence built on evidence becomes consistency. And consistency, in trading and in wealth building, comes from reading what others overlook. That's why the one pip reaction matters more than most traders ever realize. When I say noise becomes meaningful when it repeats with structure, I'm talking about one of the most misunderstood elements of price action. Traders love to dismiss small movements as noise, as if the market is just twitching randomly. But the market doesn't twitch without reason. Every tiny move, every flick, every hesitation, every drip is caused by someone doing something. Someone is buying, someone is selling, someone is pulling orders. Someone is stepping aside. If you look closely enough, you can see patterns start to form long before the crowd catches on. And let me ask you, have you ever wondered why the same tiny movements keep showing up right before the real action starts? Most traders don't pay attention to small repetitions because they expect structure to appear in big, dramatic patterns. They want head and shoulders, engulfing candles, huge breakouts. But big patterns start as small patterns. Order flow begins forming in micro movements, not the large, showy moves that everyone tweets about. The structure first appears in the little rhythm of price, a repeated one, pip nudge at the same level, a consistent tap of support, a thin rejection that appears again and again. Those aren't accidents. That's behavior. And behavior is what trading is really about. Noise only looks like noise when you're not tuned into the frequency. It's like hearing quiet footsteps in the distance, unimportant until you realize they're all moving in the same direction. When price begins repeating the same tiny reaction, that's a sign that a group of participants is acting with intention. It could be accumulation. It could be distribution. It could be short-term liquidity probing. Whatever it is, repetition gives it meaning. Have you ever noticed how a random move becomes a signal the moment it appears twice? You see this a lot around key levels. Price will approach and reject, but not with a big rejection, just a tiny one. Then it approaches again, and again the same one. Pip flick appears. That's structure forming. Something is building. Market participants are watching that area and behaving consistently when price touches it. That consistency is structure, even if it's microscopic, and structure is what separates randomness from intention. The problem is that most traders rely on hindsight. They only recognize structure after it becomes obvious. But by the time structure is obvious, the opportunity has already been taken by those who noticed it when it was small. The earlier you recognize the repetition, the earlier you understand the story forming behind the candles. Markets rarely explode in one direction out of nowhere. They prepare, they organize, they test. And those tests form patterns so small that most people don't see them until the move is already halfway over. Tell me, how many times have you said, "I knew something was building there," only after the breakout happened? When small movements repeat, they reveal the intentions of the bigger players. Big players don't slam into the market, they scale in quietly. They accumulate slowly. Their activity shows up as a rhythm, not a bang. Watch how price behaves just before a major move. You'll see small, repeated taps, mini, rejections, micro, pulls, and tight clustering. That's not noise. That's structure. That's preparation. That's someone positioning. And positioning always leaves a footprint. You don't need to guess what the market is going to do. You need to recognize when it's repeating itself. Because repetition is the market saying, "Pay attention." Once you start seeing these repetitions, you stop treating the chart like chaos and start treating it like language. The market speaks through patterns, but the smallest ones whisper the loudest about what comes next. A trader who catches those whispers understands the market earlier, and earlier understanding is where the edge lies. Think about how price consolidates before moving. People focus on the consolidation box, the obvious pattern. But before that box forms, what happens? Small repeated touches at both sides. Price flickers around the same area. It pauses in the same spots. It behaves the same way over and over. That's the early structure. That's the pre-pattern. And the trader who sees it can anticipate what others only react to. The market isn't trying to hide anything. It's just that most traders don't look closely enough. They dismiss the early signs as meaningless noise. But noise becomes meaningful the moment it organizes itself. When it shows rhythm, when it shows familiarity, when it shows a behavior you've seen before. That's how the best traders operate. They catalog these micro behaviors in their mind, so when they appear again, they know what they're looking at. And remember, structure isn't a picture. It's behavior. A repeated one, pip tap, can reveal more about intent than a gigantic engulfing candle. Because the candle is the destination. The repetition is the journey. And in trading, the journey gives you far better information than the destination ever will. The discipline comes from waiting for repetition. Not reacting to every flicker, but noticing when those flickers line up and make sense together. That's what transforms noise into signal. That's what turns randomness into pattern. That's what teaches you how to act with confidence, not impulse. Because when you can see structure forming before it becomes obvious, you no longer feel rushed. You no longer feel confused. You no longer feel reactive. You start feeling purposeful, selective, and patient. And patience is the foundation of every professional trader's money mindset. Patience is built on understanding. Understanding is built on reading behavior, and behavior starts small, so small that most of the world ignores it. When I say a single pip can reveal exhaustion long before reversal candles show it, I'm talking about one of the most overlooked realities in price behavior. Most traders wait for big, dramatic proof. A huge engulfing candle, a clear reversal pattern, something bold enough to make them feel safe. But by the time those big candles print, the market has already shifted. The exhaustion has already begun. The smart money has already reacted. The earliest clues don't show up in the big candles. They show up in the tiniest hesitation, the smallest retreat, the single pip that shouldn't have been there if momentum were truly strong. And let me ask you, how many times have you seen a strong move suddenly collapse and wondered afterward if there was a way to sense the slowdown before it became obvious? Price exhaustion rarely announces itself loudly at first. It starts quietly. When momentum is real, price behaves with authority. It moves cleanly, confidently, without unnecessary hesitation. When momentum weakens, the movements become less certain. The candles start showing little wicks that weren't there before. The pushes become shorter. The drive becomes inconsistent, and the very first sign of that inconsistency might be as small as 1 pip. That tiny hesitation at the very tip of the move tells you something changed. It tells you pressure is no longer one-sided. It tells you the side that was in control is beginning to run out of breath. Think of it like watching a runner sprint. At first, every stride is strong, long, and consistent. Then, eventually, the runner slows down, not all at once, but in subtle ways. The stride shortens, the breathing changes, the shoulders tighten. If you're paying attention, you notice the signs long before the runner actually stops. Price behaves exactly the same way. That 1 pip flick against the direction of momentum is like the runner's shortened stride. It's not a reversal in itself, but it's a clue. And if you know how to read that clue, you stay ahead of the crowd instead of reacting late with them. What's fascinating is that exhaustion often shows up right before the chart prints what everyone else calls a fake out. But to an attentive trader, it wasn't fake at all. The market told you it was tired. It whispered it. Not with a big candle. Those come later, when the exhaustion finally becomes obvious. But with tiny reactions. Maybe price pushes to a new high by just 1 pip, hesitates, and immediately pulls back. Or maybe it fails to break a level cleanly by that same 1 pip. To a beginner, that's nothing. To an experienced operator, that's oxygen. Because that's the clue that says the engine is losing power. Ask yourself, how many major reversals did you enter late because you were waiting for confirmation? Confirmation that comes from large candles is expensive. It costs you risk. It costs you positioning. It costs you timing. And timing is the heart of trading. You don't need to predict the reversal. You just need to sense the exhaustion early enough to tighten your decisions. That 1 pip shift is usually the earliest opportunity to see the story forming. Now, this isn't about overreacting to every little movement. That's how traders sabotage themselves. The point isn't that every 1 pip hesitation means the move is done. The point is that when that 1 pip appears at the right moment, in the right place, in the right context, it tells you the market is losing commitment. Exhausted markets stop moving with purpose. They stop marching forward. They start twitching. They start sagging. They start failing to do what they should do if the move was strong, and failure is information. Think about when price approaches a major level with strong momentum. If the momentum is still alive, it should tear through the level or at least press into it decisively. But if price touches the level and gets pushed back by 1 pip, just 1, the tiny rejection is significant. It means the other side is still defending. It means someone is willing to absorb the pressure, and absorption is the first step of reversal. By the time you see the full reversal candle, that battle has already been happening for several minutes or even hours. You're only seeing the outcome, not the beginning. You can learn a lot from the way price approaches its extremes. When a trend is fresh, price surges. When a trend is mature, price crawls. That crawl is visible in micro movements, even in single pip reactions that don't fit the earlier rhythm. The rhythm of a strong trend is smooth. The rhythm of an exhausted trend is choppy. You can feel the difference in the tape if you watch it carefully enough, and that single pip is like the first off beat in the music. The truth is, exhaustion is psychological before it is visual. It shows up in behavior. Traders who were once confident start hesitating. Orders that were once aggressive start thinning out. Liquidity that was once passive becomes more active. These changes show up as tiny movements in price. And if you let yourself believe that these small details don't matter, you blind yourself to the market's earliest signals. A trader who pays attention to exhaustion doesn't need to force trades. They don't need to chase breakouts. They don't need to gamble. They simply read the energy of the move. When the energy weakens, they prepare. Not predict, prepare. And the first way to sense that weakening is through the micro reactions the market prints at the edges of the move. A single pip can tell you more about the truth of momentum than the biggest candle on the chart ever will. When I say the first pip often signals intent before a major move forms, I'm talking about the earliest and quietest clue the market gives. A clue so small most traders never notice it, let alone understand it. Everyone wants to spot the big move, the dramatic breakout, the unmistakable trend shift. But the big moves don't start big, they begin with a whisper. And that whisper is usually found in the first pip that shifts when price approaches a level, a zone, or a point of imbalance. Let me ask you, how many times have you been caught off guard by a move that came out of nowhere, only to look back and see that the market actually hinted at it long before it exploded? That first pip isn't magic, it's behavior. It's the initial response of the market testing the waters. When price approaches a level, it doesn't just barge through with brute force. It scouts it, touches it, reacts to it. That first reaction reveals the tone of the market more than any indicator ever could. A strong market shows decisive pressure even in the smallest movements. A hesitant market shows conflict, indecision, or caution. The first pip reveals which of those behaviors is present, and the earlier you understand that, the earlier you position yourself with precision instead of guesswork. Think of that first pip as the first footstep of the crowd. Before a crowd runs, it shifts its weight. Before it shifts its weight, it leans. That lean is what the first pip is, just a lean. It's the earliest signal of intent. Price doesn't need to move far to show you what it wants to do. It only needs to move with purpose. When price touches a key area and reacts with even a slight push, 1 pip, 2 pips, that push is telling you what the underlying order flow is thinking. If buyers defend, they'll show themselves instantly, even if the reaction is microscopic. If sellers absorb the pressure, that too becomes visible in the tiniest movement. Have you ever watched price hit a level, pause for a breath, and thought, something is happening here, even before it actually moved? The reason most traders ignore the first pip is because they think trading is about big, clear signals. But clarity doesn't come from size, clarity comes from consistency. A small signal that appears consistently at key moments is far more valuable than a big signal that appears too late. By the time you see the big candle, the market has already committed. The early players have already positioned. The smart money has already finished making its decision. That first pip is the earliest glimpse of that decision forming. What makes this so important is that markets are always negotiating. Buyers and sellers don't wait for one another to make a big move. They react in real time to pressure and liquidity. When price approaches an area with strong momentum, the first pip will show whether momentum is genuine or inflated. If price hesitates right at the edge, even by 1 pip, it means someone is responding. Someone is defending. Someone cares about that level. That's information. And trading is nothing more than gathering information from price behavior. Think of the difference between a door opening slowly and a door being pushed open with force. Even the slightest push reveals the intent of the person on the other side. Likewise, the first pip of reaction reveals whether the market is testing the level gently, preparing to break it, or bouncing away from it. If you learn to read that early reaction, you begin to understand the story long before the story becomes obvious. Ask yourself, are you watching the market's first move, or only reacting to its last move? One of the biggest advantages of understanding the first pip is anticipation. Not prediction, anticipation. Prediction is guessing. Anticipation is reading the energy of the moment. When you see that first pip react strongly, you know the market is alive at that level. When you see it react weakly, you know participation is thin. When you see no reaction at all, you know the level holds no significance to the crowd. Knowing this keeps you from forcing trades. It keeps you selective, and selective traders preserve capital, which is the foundation of wealth building. The first pip is often the difference between chasing a move and being positioned before the crowd. If you wait for the big candle, you're late. If you wait for the obvious confirmation, you're paying a premium. But if you recognize the micro intent forming in the first pip, you have time, and time is a trader's greatest ally. It allows you to manage risk calmly, not urgently. It allows you to choose your entry, not accept whatever the market hands you. This is the mindset of a professional, not rushing, but observing, not reacting blindly, but reading the movement piece by piece. Price tells the truth early. It doesn't hide its intentions, it just whispers them. That first pip is the earliest truth the market offers. It's the moment where the crowd begins to shift its stance. It's the moment where liquidity starts moving in a new direction. It's the moment where the tape reveals the first hint of structure forming. And traders who focus on these hints never feel surprised by the move that follows, because they saw the seed long before the tree grew tall.